Money manager Eric Hickman is a number cruncher who's also a student of history. Looking at the past 100 years of market data, he is forced to conclude that the stock market is due for a whopper of a correction, one that could happen at any moment.
The history speaks for itself. I think there will be a pretty serious drawdown, a 50% plus drawdown like we saw in 2000 and 2007-8.
Hello and welcome to Wealthion. I'm Wealthion founder Adam Taggart, welcoming you back for another week of making sense of money and the markets. And this week we are lucky enough to be joined by Eric Hickman. Eric serves as president of Kessler Investment Advisors, and he specializes in sovereign debt, repo and futures, and modeling short and long-term strategies in today's markets. So I reached out to Eric after reading a report that he recently issued titled Lulled into Complacency, which I think did a really effective job of providing both the mathematical and the historical context for why a prolonged secular market reversal may be fast approaching. Eric, thank you so much for joining us today.
Thank you for having me.
Well, I'm going to start by asking you the question that I ask everybody, Eric, because I don't want to introduce any bias at the start. What is your current assessment of today's economy and financial markets?
Yeah, I think there are really three things going on. I think first you have a secular 35 plus year period of interest rates coming down and that's still intact. Secondly, you have what I call a recession era in treasury bonds, and that's the period before, during, and after a recession where interest rates fall more than usual, kind of the bull market in treasuries. And third, of course, we have this 12-year bull market in stocks that appears to be about over.
All right, so let's pivot from there to the piece that you wrote that I mentioned, Lulled into Complacency, I think you called it. In it, I'm just going to pull up a chart here quickly. You start it by showing this logarithmic chart that shows that since the beginning of 1900, so a little over 100 years ago, 1910, yeah. The S&P, which I think is your proxy there for the stock market, has had 8 defined periods of real returns. 4 of them have been good and 4 of them have been bad. And the pattern has alternated consistently from good to bad, good to bad, good to bad over the past century. And looking at the chart, it looks like the current period, which is a good period, possibly the rosiest good period in this chart, is looking pretty long in the tooth. Is that correct?
Yeah, no, that's exactly right. I think the PE being over 32 is a huge signal that we're near the end of this period. The periods seem to range between 9 and 19 years, 9 and 18 years, and we're at 12 years. But I think because the PE is so high and we do see retail participation that's crazy, NFTs, SPACs, etc., we're about done.
All right, so about done. I want to dig into that a little bit because in your report you say that culturally good periods kind of end with everybody crowded into stocks, right? That it's seen as the universal solution for investors. Kind of does seem like we're there now if you look at the markets. And you say that during sanguine times like these, people kind of forget how bad the bad periods can be. Because those bad periods, they see a lot more volatility. And I think you say too that when they have, both good periods and bad periods can have drawdowns within them, but the drawdowns within the good periods are much shallower, like 15 to 30% at the worst, where some of the bad periods can have drawdowns of like 50 to 80%. So I guess my question for you is, you say that at the end of a bad period, it's sort of like the opposite of the good period. People are swearing, I'm never going to own another stock. It seems almost unimaginable now, given people's appetite for risk and kind of the complacency that's out there in the market. I guess I want to just, there's a quote that you had here I want to read back to you. You said, "The unprecedented consistency of this bull market has created the appearance of a sure thing, exemplified by the Reddit mantra of stonks always go up. Risk has never been so forgotten." I think that last sentence was really key here, risk being forgotten. How vulnerable do you see the current market environment be given this complacency?
Well, yeah, I mean, I think the history speaks for itself. I think there will be a pretty serious drawdown, a 50% plus drawdown, like we saw in 2000 and 2007, 8.
Okay, and I'm sorry, just to make sure people heard you correctly, you said 50, right? 50?
50 plus. Yeah, I think it'll be a major bubble breaking type of event. And there's nothing that unusual about that. That's a pretty common occurrence. It's just that we haven't seen that. Now, we did get 30 with the pandemic, but we haven't seen a big drawdown since 2008.
Yeah, and the pandemic drawdown was pretty darn short-lived. All right, well, look, with things this rosy, or with sentiment this optimistic, one of the byproducts of that you mentioned earlier is that PE ratios are extremely high. In fact, the 32 times PE ratio currently for the S&P is the highest it's been on record, and you showed a chart that I'll display here. Is there any credible argument that it is different this time and that high PEs like this can be sustained, or do you feel that mean reversion kind of is inevitable?
Several people have told me that there are excuses for all of this, but the way I think about it is, if the time series is long enough, that increases its importance. And the fact that PEs I have back to the 1800s, if you look at that series, we really are at 32 or maybe 31 now. And despite excuses for that, I think that is a real issue. I mean, when people are paying 32 times what current earnings are.
Yeah, and I guess where I was going with this question is there anything conceivably, and I'm asking because I really can't think of one, but that could have happened sort of fundamentally to merit that stock should be valued at a higher valuation multiple than they have in past decades or centuries? You're right, your chart here went back to 1870.
Well, I think the best excuse given, or the most common excuse given, is that because rates are zero, that you can discount cash flows and have a higher PE. But my thinking is that rates were really at zero for 10 years before that too, and we didn't have these high prices. So that, and then also, I mean, I do think that the Fed and Treasury can elongate cycles. I think they are involved in that sense, but as Jeremy Grantham said, I called it the false idol of this cycle, that it's impossible for anything really to stop a big stock drawdown. And that's the reason why it gets so high in the first place, is because people think it is bulletproof. Yeah,
well, so there are several questions I want to get to based upon what you said. I guess let me start with this one. Going back to your first chart, you revisit it in your piece and you talk about kind of the concept of mean reversion. I'm going to call this looking at the median return of the market, where you look at the real returns that the market offered, and you're looking at, okay, what's the return rate at which the market has spent an equal amount of time above and below that rate. So it's kind of like the median. And I think you calculated that it was about 5.75%. And
that's real, which is important.
Yeah, real return. Yeah. And I think you said that for the S&P to return to that real rate, if it were to do so today, that it would need to fall 45% And then you acknowledge that corrections tend to overshoot, so it might fall even further than that. What kind of probability do you put on that? I mean, I guess you mentioned 50% early in the conversation, so maybe you put a very high probability on that.
Yeah, I mean, I think it's inevitable at some points, even if it's 2 years from now, which I don't think it's going to be. I do think it's going to happen now-ish, let's say this year. But no, I think that markets have to mean revert. It's just gone on above the mean for too long.
All right, and I'm going to want to talk sort of about triggers for you, because of course that's the big question that everybody asks, right? It's the when question and the what's going to actually cause the party to end. And one potential factor, you kind of begin to go through in your report, reasons why the market is more vulnerable than perhaps people realize it is to some sort of sizable correction like that. One of the things you talk about is the current lack of dividend support for market prices. Historically, you point out, which is very true, that market returns for investors or returns to investors from the market have usually been driven 2/3 by dividends, not by price appreciation. That is not the case right now. And if you look at the S&P dividend yield today, it's around 1.4%, whereas historically it's been around 4.3%. So it's like, I think less than a third of what it normally has been.
Yeah, I think that really matters for forward returns. The past return did have 2/3 of it in dividends, and we have 1.4% now. It's a lot lower, and that's important.
Yeah, well, I guess right before we move on, like how material a factor do you see that lack of dividends? Is it just sort of one potential straw on the camel's back, or is that a particularly heavy element here?
Well, I think it's typical. I think that as the market goes higher, the momentum is really the thing that the market wants or is feeding off of, and the dividends don't matter. But then when you return to more of a negative returning period, the dividends are what attract investors back in. And so when you get to the end of a positive period like we have now, the dividends will be low, and then they'll rise to attract capital.
All right, and I'm just curious, do you see the current low dividend rate or low relative dividend rate as more of a sign that companies might not be corporate America might not be as healthy as people assume, or are companies just doing it because they can get away with it?
Yeah, I would say the latter. I think big companies are healthy at this point. That can change on a dime, but yeah, I think it's more of the latter, that you do not need to have dividends to attract investment.
Right, which is probably just a very good metric of market froth, right?
Yeah, no, exactly.
When they don't feel like they need to pay you to buy their stock, that's probably a sense that they're, yeah. Good sign of hubris. Okay, you also talk about, there are people out there who kind of compare coming out of COVID to coming out of, the world's last global pandemic back in 100 years ago, the Spanish flu. And a lot of people say, well, we had the Roaring 20s after that, so we're going to have another Roaring 20s decade here in 2020, starting in 2021. And you seem to say, hey, not so fast. I think you give kind of three good reasons. One is that we talked about those bad periods, good periods in the markets at the beginning of this interview. 1910 to 1920 was a bad period, so you were swinging into a good period at that point in time. Here we have potentially the opposite, right, where 2010 to now has been a very good period. Secondly, we've been talking about PEs. The market PE back, at the start of the 1920s was around 9.3 times. Now we're at 31, 32 times. So again, we've never been that high before. Yeah, huge difference. Yeah. And then lastly, you rightly said that 1920 followed, the 1920s followed World War II, right, where you had the economic boom from the, sorry, World War One, I'm sorry, exactly, World War One, where you had the economic boom of, the war being over and the victorious countries, reaping all the economic productivity and development from that. Here, we don't have a similar analog to that. So those do seem to be three pretty compelling reasons. Does anybody push back on those, or anything else to say about why we're not going to have the Roaring '20s here?
Yeah, no, a good question. No, I have not heard anything back to that. I think those are pretty strong arguments. I'm not sure that anyone's really looked back to the 1920s to see what it did look like. Once you look at the data, it's pretty clear. But and some of that data is not so easy to find, but once you do look at it, it is pretty clear.
All righty. You also kind of went through a litany of signposts that the end is near, in your words. But these are basically just, I think, signs of sort of systemic excess or instability. And I'm just going to list.
Maybe you would say.
Pardon me?
Exuberance.
Exuberance, sure, exactly. We'll rip off Greenspan there. So I'm just going to list them off, and then I'd love for you to sort of react to whichever of these ones you're either most concerned about, or any others that you might want to have added to this list since you composed it. But you listed off, story tech stocks, Tesla being, kind of near the top of that list, meme stocks like GameStop, cryptos, obviously, and I mean, anybody watching what's going on in Dogecoin right now is just stupefied. The NFTs, and certainly, people spending hundreds of thousands to millions of dollars for single pixels or images that you can just get for free off the internet seems crazy to a lot of rational observers. You talk about SPACs, and you talk about sporadic blowups like we had with Archegos. So I'll let you riff on however you want to respond to that. But
no, sure. I think SPACs are probably the biggest of all of these, because it really does make it appear as though a company not ready to be public is public. It gives a loophole to be able to do that, and there are disclosures that you should have to be able to be public that they don't have, or a business model that makes sense. So to me, that looks like the place where we will see fraud. I was reading something today that the SEC is beginning to take apart what's going on in the SPAC world. But I think that's the biggest one. Then crypto. Crypto, I feel like will be important going forward. I don't think it's going to go away. But to me, it reminds me of what the internet was, or what dot-com companies were in 2000. An immature industry that needs to retrench and shake out the weak ones before it can move forward. But those prices are moving very fast. Yeah.
Yeah, they are for sure. And let me ask you this. I don't know how closely you follow the crypto space, but I have been kind of beating my head against the wall of late, past couple of weeks, watching Dogecoin, which for those of you, viewers who may not follow crypto very much, Dogecoin is a cryptocurrency that was initially created purely as a joke, and does not have the deep ecosystems that a Bitcoin or an Ethereum does. In fact, it has code that is pretty much just almost an abandoned code base that's been very, very sporadically tended to over the years because it was a joke. There was really no reason for it to evolve. And also there's sort of an infinite potential supply of these things, unlike coins like Bitcoin. And Dogecoin has gone from tenths of a penny at the start of the year, or even less, to now I think as of yesterday 70 cents. which when you measure that on a percent return, it's just staggering. It's now worth $90 billion, right? Which is worth more than like Ford or General Motors, companies that have been making, supplying a huge chunk of the world's cars for the past century. Now some dusty spaghetti code that really has no purpose and can be, printed ad infinitum is now worth more than those companies, which I give all that background to say, Eric, is there any plausible reason why that is not just a sign of extreme excess? I find it hard to imagine something that's even more speculatively reckless than that.
I would agree with you. I think crypto has issues in the sense that the anonymity issue, governments are not going to accept that long term. You have to have IDs to accounts, and that's the only way you can prevent money laundering. It's the only way you can regulate things, and so that's a hurdle that Bitcoin or crypto has yet to deal with, and I think that's a big deal.
Yeah, I agree with it. And look, for crypto fans that are watching, I'm not picking a fight here with the cryptocurrency community. I attacked Dogecoin because I think that is ludicrous. When it comes to Bitcoin, Ethereum, all the more sort of established coins there, if we can use the word established, I don't know what to value them at. And my commitment to you guys, as I've said recently, is I'm going to bring some more crypto experts on to make more sense of this. So don't think that we're picking on crypto specifically here. But I do think that what you said about kind of comparing the crypto space to the dot-com space of 20 years ago, there probably is a fair amount of truth to that. I don't think anybody doubts that the blockchain is going to be transformative. But are the existing players, do they merit the sky-high appreciation that they've seen this year? Don't know, but as somebody who started his career in the dot-com era, I do see an awful lot of similarities here. So I thought that was a pretty apt analogy. Just secondly, too, talking about SPACs, in my mind, hearing you be concerned about the lower degree of scrutiny that those offerings get versus your traditional IPOs, it does seem very similar to the subprime debt situation back leading up to 2007, 2008. Where you just had a lot of debt that was getting issued without, going through the appropriate scrutiny.
Yeah.
SPACs to me feel kind of like subprime equity, right?
Oh yeah, no, that's a good analogy. I hadn't thought of that. Yeah.
Yeah. Where afterwards, when if these things do indeed blow up, people are going to be looking back saying like, how did that ever get approved?
Well, and I wrote to my clients today something with that Warren Buffett quote that you only know who has their swimming trunks on when the tide goes out. And I think that would certainly apply to SPACs. I think fraud will become apparent, or lawsuits and trouble will happen once values begin to come down. And I think SPAC values certainly have come down. I think the SPAC index is down 50% or something like that.
Yeah, well, they performed horribly.
Yeah, yeah.
You would think people would say, look, I don't want to buy them because they're bad performers, but I think
they didn't always. There was a time when they went up a little bit. Right,
initially coming on, but I think the fact that they're still around is a sign of froth, right? Which is that, in frothy times, bad investments get funded just like good investments do, right?
Well, and I think from a regulation standpoint too, that was a vehicle that existed going back to the 80s. When prices are going up, no one's complaining about anything, so there's no reason to regulate it. It only becomes important to regulate it once people lose money. So I was reading something today, the SEC is really approaching that or attacking that issue. And I think there's a lot to be done there.
Yeah, and I think you're accurate in terms of how nobody complains when things are going up, but it is kind of like your bank telling you, well, sorry, we lost your money, but we only really hire a security guard once the bank's been robbed.
Yeah, there you go. That's another good analogy.
All right, well, let's get into sort of what the trigger could be, because I think that is really what people who share your skepticism are really, desperately sort of trying to pinpoint here, is candidates for what could be the trigger. Earlier, you mentioned the term false idols, which you mentioned in your article. It sounds like you took it from Grantham, but you had said that fiscal and monetary stimulus is this generation's false idol, and that this isn't unique, meaning that every one of those good periods on the century-long chart that you pulled out there, by the end of it, there was some dominant narrative explaining why stocks are never going to go down again, right? The permanently high plateau right before the 1929 market crash, or Bernanke saying that, it was Greenspan, I think, saying that.
Irrational exuberance.
Well, or that the housing was too distributed, the housing market was too distributed and hyper-localized to ever go down on average, right? And then, of course, we had the housing crisis in 2007. So you quoted Grantham, and I want to read this, then I'll ask the question. But I thought this was a great quote from Grantham that he wrote in January, predicting that the market was going to roll over this year in late spring or early summer with the rollout of the COVID vaccine. He said, at that moment, the most pressing issue facing the world economy will have been solved. Market participants will breathe a sigh of relief, look around, and immediately realize that the economy is still in poor shape. Stimulus will shortly be cut back with the end of the COVID crisis, and valuations are absurd. This is a buy the rumor, sell the news moment. So, the vaccine rollout has progressed on the timeline, more or less, that Grantham predicted. So we now are in early spring. So we're getting pretty close to the late spring, early summer. How prescient do you think that call is going to be from Grantham?
Yeah, it's a good question. I think that he wrote that before the 1.9 trillion was passed. He wrote that piece January 4th.
Right. Yep.
So I'm not sure what he would say today, but as he said in that piece, and I really think that that's true, all of the preconditions are done. They're in, and so he titled his piece "Waiting for the Last Dance," and I think the word "waiting" is part of the thing here. We really do have to wait, and it's just as likely to happen in June of this year as it is kind of June of next year. Like, the margin of error of this type of a call is not that specific. We all want it to be. I understand that. Now, one thing that I'll mention, this is something that our founder, Robert Kessler, had noticed, is that between when bonds peak and when the stock market peaks in the last two recessions is either 2 to 4 months. If we assume that the 30-year peaked in mid-March, we're certainly 25 basis points lower than where it was in mid-March. That would mean between May and July that we have the stock market peak. So that's kind of a model to look at the timing.
Okay, that's interesting. And I'm going to ask you about bonds in just a moment. Yes, I agree. Look, I'm not going to hold you to this. Nobody knows what tomorrow's going to bring. Nobody knows exactly when this market's going to pop. Although we all love to hear people prognosticate on it. But I thought that Grantham's core premise was it's basically going to be a sell the news event after the world kind of realizes that it is the vaccines are deployed. Enough people are vaccinated that the concerns of the pandemic really start dying down, and we're going to look around and say, "Geez, you know what? Congrats to us. We conquered COVID or got it under control, but you know what? Our economy is actually not doing all that great."
Yeah, one thing I think was important that he said as well, which we've talked about for a long time, is that there's a question of how much is priced in. If there's a whole bunch of future growth priced into the stock market, which I think is probable, it's just a reassessment of that future that can bring the market down. And so to look at it, you wouldn't say that there's necessarily a catalyst. It can just be from people reassessing their view of the future slightly, and that can bring the stock market down.
Yeah, particularly when you're at a 32 times PE ratio. You know, if we were at an 8P ratio, I think we could be having a very different discussion. We hope you've been enjoying this conversation with money manager Eric Hickman. The interview continues over in part 2, where Eric estimates just how painful the coming correction may be, and more important, shares his thoughts on how today's investors can position in advance for it. To watch part 2, just click on the link provided in the description to this video below, or simply go to youtube.com/Wealthion. But before you go, please don't forget to click on that subscribe button if you haven't already. Oh, and if you'd appreciate a no strings attached portfolio review, completely free, by a financial advisor who appreciates the market risks that Eric's been warning of, just go to Wealthion.com and we'll set one up for you. Okay, I'll see you over at part 2 of our interview with money manager Eric Hickman.